The New South Wales pub market has enjoyed buoyant trading over the first half of 2016, with extended summer and favourable autumn weather conditions, enhancing on-premise trade across the state. In particular, Sydney's food and beverage-centric operations capitalised upon the continued consumer trend of dining out with increased frequency and seeking value food propositions. In addition, gaming and wagering performance for the first two quarters illustrated an ongoing growth trajectory, albeit at a lower level than the previous 2 years of record growth in these departmental contributions. Not surprisingly, hotel transaction volumes for the first half have been at their lowest levels in New South Wales for nearly 4 years, as supply constraints restrict the flow of equity to the sector and acquisition opportunities are scarce. Demand is both strong and consistent across the asset class for all types of hotels within Sydney and the coastal areas, with investors just starting to look further afield to inland regional centres as acquisition targets. There have been further off-market transactions of hotels occupying alternate use sites, driven by developers and new private equity hotelier JVs. The interest in leasehold hotels has risen markedly, with operators chasing yield opportunities where their experience is best leveraged. Notably, there's not been one single gaming hotel worth over $20 million offered publicly to market in the whole of the first half, which shows an ongoing tightening of supply of top 200 gaming assets. The balance of the year is set to see limited hotel transactions as supply constraints extend into 2017. Fundamentally, there's just more equity seeking hotel acquisitions at present than there are sellers, with buying a hotel not going to get any easier and acquiring a top 200 gaming hotel foreseeably looking to be very challenging in Sydney. The market is at its strongest since 2006, where a range of robust corporate balance sheets and transaction drivers saw yields compressed to unparalleled levels, even in a higher interest rate environment. Yet yields have stabilised at this point, whereby valuers, debt providers and purchasers have found a comfortable spread between the cash rate and required return on equity. Basically, the market's wiser now than it was 10 years ago and seems to have found its natural transaction level. So even with strong demand, pricing has not reached the highs of 2006, nor is it anticipated to do so. Corporate activity surrounding the Lantern Group's continued sell-down of non-core assets, Dixon Hospitality's abandoned IPO plans, the recent unfortunate administration of the Keystone Group, and the ongoing efforts of Red Cape shareholders to exit their interest will of course have some bearing on the balance of the year, by facilitating some market liquidity, but also by underpinning and driving market sentiment. Yields are not expected to tighten any further, however we will no doubt see anomalies where, for strategic reasons, buyers find ways to substantiate bespoke acquisitions of underperforming assets at competitive price points.